G'day folks, welcome back to another update for the SP 500 and the NASDAQ, which continue to decline. Make sure you hit that like and subscribe button to support the channel. We're going to include some back testing in this video as well, in terms of where you should get in and out of the trades to show you how that would have worked. Before we go there, make sure we've got the you understand the fundamentals first. As of today, March 19, valuation levels, the SP 500's Shiller PE ratio stands at 34.47, significantly above the historical average of 17.2. Indicating elevated valuation levels. Market corrections, both indices have entered correction territory, with S&P 500 down 10.1% and the NASDAQ composite down 13.7% from their recent highs, reflecting heightened market volatility. In terms of investor sentiment, a Bank of America survey reveals a historic reduction in US equity holdings, with allocations shifting from 17% overweight in February, 23% underweight in March, signaling increased caution among investors. Economic concerns, ongoing trade tensions and tariff uncertainties are contributing to fears of a potential recession, adversely affecting investor confidence and market stability. And in terms of sector rotation, investors are reallocating funds from US technology stocks to sectors like utilities and banking, as well as increasing exposure to European equities, indicating a strategic shift in response to current market conditions. So we always start with the long-term trends, with the monthly, the weekly and the daily. So on the monthly, you can see there we've got a bearish divergence with the CCI lower highs and the price giving us higher highs, which is a bearish divergence. Now you'll notice on the CCI it's broken below the moving averages, and that's a bearish outlook. Let me just expand that. Now I've got a couple of target areas there. So it depends where you draw the first Fibonacci retrace. So if I was to draw it from that point there, that high point, so if we take the Fibonacci retrace and then we take it back to that level, you can see there that's at 23-38% range and hasn't reached it yet. And let's get rid of that first one to make it a bit cleaner. So it's come back to this 23-38%. That's what we're looking at as a minimum. And at the moment, it's actually started to retrace. So just keep mindful of that on the monthly. On the weekly, likewise, we've got another bearish divergence. We've had a couple of them here. You can see there in those smaller ranges, and currently you've got those higher highs on the price there versus lower highs on the CCI, and that's still declining. A slight pullback this week so far, but nothing too dramatic. We'll go down to the daily in a minute, but again, that's already broken past the minimum range at that point there, the 23-38% level. And on the daily, it's actually hit this resistance up there at 61.47, almost a double top, broken down past the minimum range if we draw a Fibonacci down to that point there. And depends how far you want to go backward. If we draw a Fibonacci from that high to that low, you can see there it's broken past the 50% and coming close to that 61%. Had a bit of a bounce off that 61%. You'll notice the CCI is actually broken into that moving average range. So again, I'd wait for it to break below that moving average range to start taking short positions. Alternatively, it could still rise, and we've got this diagonal ascending trend line, so it could actually still retrace back to that level, possibly. But I wouldn't be going long at this point. I'd be waiting for it to confirm with a break above the price, above those moving averages, but also above the moving averages of the CCI to be bullish. If we went to the intraday chart, see if there's any micro moves. You can see there we did draw this higher lows on the CCI up until that point on our previous video. Now that's actually dropped slightly more since then to that level there. And if we were to draw a Fibonacci retrace, we take it back to that low, to that high, and that's where we then reassign this. Let's move that there to that level there. You can see there it's already hit the 23-38% level irrespective, but it's actually gone as high as the 38% at that point there, and it's bounced to the downside. Now the CCI on the 1 hour is broken higher than on the CCI moving average, but notice the price is still below it. Again, even if that breaks above it there, I still like to see the daily break higher on the moving averages to go long. In other words, I wouldn't be going long at this point until we take the direction of the daily. At the moment, if this the price is below the moving averages, if the CCI breaks below, that's a new entry for a short position, so long as the daily is also bearish and below the moving averages. So in terms of the back testing, I've started the back testing here at that point there, which coincides on the daily where the price broke below the moving averages there, and also the CCI was below the moving averages. So the top back testing here is the stop loss approach. So you enter, each of these little bars indicates an entry and an exit. You can see there's a few stop loss actioned, and where the baseline is 100,000 and the price fell below that. So it did fall below, then a couple of them were profitable, fell below again, and ultimately if you kept it through that whole period, currently you would have made $436 trading on a per contract on a stop loss approach. On the average down approach, this maxes out, and stay to the end of the video to see the averaging down segments and how many contracts you should enter. But you can see there through that whole period, you've averaged down a few times, and you would have made, on a baseline of 100,000, you would have made 10,400, currently at 491, still rising or dropping. So again, you're still in a contract with 15 contracts on that one there, versus say 10,400 versus $400 on the stop loss approach. So the NASDAQ has a similar story. This is the monthly. You can see there I've drawn a Fibonacci already. It hasn't quite reached the target range yet, the 23-38% level. But again, similar to the S&P, the CCI is broken below that moving average, a very narrow moving average, and the price is still above the moving averages. So turning bearish, although the price is still somewhat bullish. On the weekly, another Fibonacci retrace along with a bearish divergence. Again, you can see that with that wick, it's just touched that 23% level, and it looks like it's still going to drop. So weekly bearish movement at the moment. The price has also dropped below the moving averages. On the daily, again, similar to the S&P, it's almost a double top there. It's touched that resistance at 22,225, dropped, hit the initial target range at 23-38% Fibonacci. But again, you would have closed out your position on that candle, and you would have reopened it if you're trading on the daily time frame. You would have reopened it on that level there, went just on that candle. So currently, you'd still be in the money on that one. But just be careful. We could still see a slightly bullish today on the daily, and we could see a rise towards this diagonal trend line. Just be cautious. But at the moment, the CCI is broken below, so that gives you a trading green light, if you like, to go short. If you go to the intraday chart, let's see what's happening there. If there's any pullback, and there is a slight pullback. Currently bullish movement on the hourly, but again, bullish on the CCI at least, but not on the price. The price is still below the moving averages. And we did have a bit of a pullback during this period. Again, it coincides with that area there on the daily chart. So again, I don't see any divergence, any bearish divergence or bullish divergence. There was a bullish divergence back here. We forecast that, higher lows on the CCI versus lower lows on the price, and we drew a target range there. You can see there on that 23% level, it hit that with those candles there on the 1 hour time frame. So again, we just may see it approach this descending diagonal trend line possibly. So again, if you were going to go short on the hourly, wait for this to break below on the 1 hour time frame. So for the back testing, similar to the S&P, again, going short on the hourly when the price and the CCI break below the moving averages at that point there. That coincides with this back testing period. So on the stop loss approach, so far, had you let it go through the whole period, it would have generated $557, and the average down approach would have generated $6,173. But again, I prefer to close it out, so I would have closed it out at that level there. If I was to mark it with a cross, so on that candle there, when the CCI broke into that moving average range, I would have closed it out at that point there on both, if I was trading on the stop loss, and that would have generated, on the stop loss approach, that would have generated about $528, and on the average down approach, it would have generated $5,191. So always pay attention to the daily trend and run your hourly trades, if you're trading on the hourly, in the direction of the daily, and stop it out when it, close it out or with a stop when the daily hits that moving average range of the CCI. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade one contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is one contract, next lot is 3, you got a total of 3 contracts now running. Add another 4, you got a contract, 7 contracts running, add another 8, and then you got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade, $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest one contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return. To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.